Inflation. You hear this word everywhere, right? On the news, from your friends, every time you go to the grocery store. But what is this invisible force that's constantly, quietly chipping away at the money in your pocket? All right, let's dive in and get to the bottom of what it really is. Okay, to really get a sense of its power, just look at this. A single dollar back in 1913 had the same buying power as over 26 bucks today. And now a dollar is, well, it's just a dollar. That is a huge drop. So what in the world is going on here?
Well, to answer that, we've got to start with the basics. Let's get a really clear definition of what this powerful economic force actually is.
So here it is, plain and simple. Inflation is basically the decline of your money's purchasing power over time. Think about it like this. That $10 bill in your pocket, a year from now, it's going to buy you less stuff than it does today. It's this slow, kind of sneaky, but totally relentless process. And that's why it's got this perfect nickname, the invisible tax. I mean, think about it. No one sends you a bill for inflation, right? It just happens. It quietly siphons off the value of your savings, your paycheck, without you ever seeing a single line item.
Okay, so if this thing is invisible, how in the world do we actually measure it? I mean, you can't just track the price of everything, can you?
Well, it turns out they kinda do. Economists have this clever tool called the Consumer Price Index, or CPI. What they do is create a sort of virtual shopping cart, a basket of goods and services that a typical person buys. And we're not just talking bread and milk here. This basket has 299 different items in it, everything from a gallon of gas to a haircut, even movie tickets. Now, this is where you get those two terms you always hear on the news, headline and core inflation. It's actually pretty simple. Headline inflation is the whole shebang. It looks at the price changes for all 299 items in the basket. But you know how gas prices and food prices can go totally crazy up and down? That's why they also calculate core inflation. They just take out those two volatile categories to get a clearer picture of the more stable underlying trend. Right, but not all inflation is created equal. You have your slow, creeping inflation, which is actually considered normal, maybe a few percent a year. Then it can start walking, then galloping. But when it goes completely off the rails, that's when you get the most dangerous kind of all, hyperinflation. And if you want to see what that actually looks like in the real world, you don't have to imagine it. We have a very real and honestly a truly tragic example from not too long ago. Let's talk about Zimbabwe. Just look at this number. That is 79.6 billion%. That wasn't for a year. That was the inflation rate for a single month, November 2008. It's a number that just breaks your brain, you know? To put it in perspective, prices were doubling pretty much every single day. And this quote just says it all. The situation got so absurd that the government started printing $100 trillion bills. $100 trillion? And you still couldn't even buy a bus ticket with one. Your money was literally worth less than the paper it was printed on. So you have to ask, how does a country get to that point? Well, it was a total perfect storm of bad decisions. Believe it or not, back in 1980, the Zimbabwean dollar was actually worth more than the US dollar. But then came a series of disasters, controversial land reforms that wrecked their food supply, and then the government just started printing money like there was no tomorrow to pay for military spending and its debts. It was a complete death spiral, and by 2009, the whole currency was history. They just had to scrap it. Okay, so the story of Zimbabwe is obviously an extreme case, a real worst-case scenario. But it brings up a question that every single one of us has to deal with, just on a much smaller scale. If we know for a fact that the cash we're holding is going to be worth less tomorrow, what do we do about it? How do you protect your money? And that's where this whole concept of an inflation hedge comes into play. It's a simple idea, really. You want to find something to buy, an asset, that will hopefully hold its value or even grow faster than inflation is eating away at your cash. For centuries, the go-to answer was gold. But now there are all sorts of new players in the game. The search for the best shield is definitely on. All right, let's look at some numbers from one study that compared a few options. You've got your old school hedges, right? Gold and the S&P 500 stock market index. They deliver pretty modest returns day to day, but the key is they're stable, low volatility. Then you look at the other side. You've got cryptocurrencies like Bitcoin, Ethereum, and XRP. The average returns are way, way higher. But, and it's a huge but, look at that volatility. These things can swing wildly, making them a much, much riskier bet. So, what did this specific study conclude? Basically, that even though the big returns from crypto look amazing on paper, those crazy price swings make them just too unreliable to be a good inflation hedge. In this showdown, the S&P 500 was the winner. Why? Well, because it's a slice of many big companies, and those companies can often raise their own prices to keep up with inflation, which helps the stock index hold its value. And that brings us to the big, final question, doesn't it? Inflation isn't going anywhere. It's a fundamental part of our economy. We've seen what it is, what it can do at its worst, and some of the ways people try to fight it. But in a world that's changing faster than ever, the hunt for that perfect, unbreakable shield for your money, well, it's definitely not over. So, what do you think the future of hedging will look like?